Hi dear students, welcome to CAT course offered by St. George's College, Arivitra. This is paper 1, Fundamentals of Financial Accounting, video number 5. In this video, we are going to discuss two basic concepts. The first one is the basic principles underlining the accounting procedures and certain modifying principles. So that is the topic of this particular video. So let's first discuss about the basic principles. The first one is the revenue realization concept. So what do you mean by revenue realization? This concept says that at one point of time the revenue is treated as recognized or realized. So the concept says that mere getting an order from the customer won't make it eligible to recognize as a revenue. So if the revenue is to be recognized or to be recorded into the books of accounts, either the products are to be sold or the legal obligation is to be created. Just creating an order will not satisfy the condition of revenue recognition. So to give it more clarity, I could say that the order could be cancelled at any time and that particular sale can end at any point of time without the realization of the money. So that cannot be recorded into the books of accounts. So the concept says that it can be only recognized when the revenue is actually received or when the legal obligation for the receipt of the revenue is actually created. Then at that time only it can be treated as a revenue recognized transaction. Otherwise, those transactions should not be recorded into the books of accounts. So this particular concept gives a clear indication that if the unreceived revenues are given or recorded, then it will result in inflated profits. So if just an order, if it is received and that is treated as a revenue and if it is recorded into the books of accounts, automatically that may have a portion of profit also. So the profit of the business will go up without the actual happening of the transaction. So the drawback, if it is not being implemented into the business, is sometimes the profits of the business can be inflated. So to remove that particular disadvantage or to overcome that disadvantage, this particular concept is there, and the concept is known as revenue recognition concept, and the revenue is treated as recognized when it is actually received or the legal obligation is created, and a mere order doesn't mean that the revenue is recognized. That is what meant by revenue recognition concept. So the next one is known as matching concept. Matching means you are bringing two things together, which means we are matching the incomes and the expenses. So that is what meant by the matching concept. So this concept can be easily understood with the help of an example. So let's see the example. The sale of goods. So that is the example. When a sale happen to the goods, there are two important aspects. The first one is the goods are going out and you are receiving the money. So there is a revenue aspect, and this aspect will increase the owner's equity because the cash is received. And there is an expense aspect or a loss aspect, which means the goods are moving out from the business and the owner's equity is again coming down. So when a transaction is taken, it automatically results in a revenue aspect as well as the cost aspect. And the condition is that these two things should happen together, and if the two things to happen together only, we can match these two things, and it should happen at the same period, and that will result in the net effect of your owner's equity. So to generalize, when a given event is having two effects, one of it is revenue and other one is expense, both must be recognized in the same accounting period, then only it could be matched, and the result of the matching is either a profit or a loss, right? The result of the matching is either a profit or loss. So here the matching principle says that or the matching concept says that we are matching the revenues and expenses together, and the net effect of it is either the profit or the loss, and the condition is there, these two things, the revenue aspect and the expenditure aspect, that both things should come together, then only it becomes a matching concept or a matching principle. Now we are moving to the next concept, that is the full disclosure principle or the full disclosure concept. So this concept says that all significant information which happened to a particular business should be fully disclosed. So here a particular word is very much important, that is significant information. Significant information here means all information which is affecting the business, affecting the earning capacity of the business, that is known as significant information. So those information, even though the money value will be comparatively less, but the decisions, the informations are more significant. So those significant transactions, without considering the value, the high value or the lower value, should be fully disclosed into the books of account, and that is known as the full disclosure concept. So the accounting data should properly be clarified, summarized, aggregated and explained for the purpose of presenting these things into the financial statements, because we know financial statements are used by many persons, and that should give a clear-cut clarity about all the items which is presented in the financial statements. That is why the significant information should not be avoided. It should be fully disclosed into the books of accounts, and that compulsory decision or the compulsory decision to be taken by the accountant is being ensured by the full disclosure concept or full disclosure principle. Let's move to the next one, that is dual aspect concept. Duality means two, which means every transaction that happened in a particular business is having a two aspect, that is the debit aspect as well as the credit aspect. That is known as the dual aspect concept. So this concept says that every transaction is having a dual impact, and this duality concept gives the double entry system of accounting. So that is the debit aspect and the credit aspect. So in the present form, the double entry system is owing its birth or owing its existence to the Italian mathematician named Luca Pacioli, and he is the first person to introduce the concept of this double entry system, and in the year 1495 in the mathematics books. Okay, so he is known as the father of accounting, Mr. Luca Pacioli. So based on that, the accounting equation is being created, that is assets are equal to liabilities plus capital. So that is the dual aspect concept. The next one, it is verifiable objective evidence concept, which means it says that there should be a verifiable object, which means a proof is to be required for supporting every transaction as an evidence, and the transactions which are not having this verifiable object, it should not be recorded because it is not having any evidence. So the accounting data should be verified, and for verifying that there should be an evidence. That may be a voucher, that may be a slip, or that may be a payment slip, etc. This could be produced for verifying its objective evidence. So in other words, documentary evidence of the transaction should be there for verifying the every transaction into the books of account. So this is to create unbiased data. If there is no evidence, that can be biased, the data could be biased. So to avoid these biased data, there should be verifiable evidences to support each and every transaction. The next one is historical cost concept. The historical cost concept says that all the transactions are recorded into the books of accounts on its historical cost. So the historical cost here actually means It is the actual cost that is taken at the time of purchasing a particular asset. So here the historical cost actually indicates the actual cost at the time of obtaining that particular asset, and on the basis of this actual cost we are charging the depreciation, and the asset values are shown the books of account at its historical value. Historical value once again means the actual value in which the particular asset is obtained. Okay, and the limitation is there. The limitation of this concept is that balance sheet does not show the market value of the asset. So every year the assets will not be revised to its market value. It will still remain in the books of account at its actual historical price less depreciation. So it will not be matched with the market value. So that is one of the limitation when we follow the historical cost concept. The next one is the balance sheet equation concept. So we know what is the balance sheet equation. That is, assets are equal to liabilities plus capital. So this balance sheet equation actually comes from the duality principle. The duality principle says that every transactions are having two aspects, and this two aspect is known as the debit aspect and the credit aspect. So we know, as per the rule, which all items are debited. We are debiting all expenses or losses, and we are crediting all incomes and gains, and also all the assets are having debit balance and the liabilities are having credit balance. So this debit is equal to credit can be rewritten as expenses plus losses plus asset is equal to revenues plus gains plus liabilities. And we know these expenses or losses and these revenues and gains, they will be matched together, which means at the end we can say that the assets are equal to liabilities, or these assets will be equal to the liabilities plus capital, that is equity plus the external liabilities. So that is what meant by the accounting equation. It all comes from the duality principle, that is all the transactions are having two aspects, the debit aspect and the credit aspect. So what is the accounting equation? Assets are equal to liabilities plus capital, that is the balance sheet equation. So these are the basic principles, and we are moving ahead with the some of the modifying principles. So first one, the concept of materiality. So we know many transactions are having are being happening in our day-to-day life in the company, on the business, but all of the transactions are not material. Material here means important. Some transactions may not having a decision-making capacity, but some of them are having a very high decision-making capacity. So that is what meant by the materiality. So it proposes that accounting for various transactions, only those which is having a material effect on the profitability. So here materiality means it is important relating to profits. So if a transaction which is having a positive or a negative impact which is related with the profits, then that should be reported and that should be recorded into the books of account, which means immaterial or not relevant or insignificant transactions. Those transactions can be completely avoided at the time of recording the transactions into the books of accounts. The material could be related to certain information, amount, procedure, or any certain set of natures. So that could be recorded and that should be reported also to the top level management. So that is the concept of materiality. Here materiality means it is having a material effect on the profitability. Those transactions are to be compulsorily recorded into the books of accounts. Next one, the concept of consistency. Consistency means we should stick on to a certain set of rules and regulations, which means if we are following a particular accounting practice, then that should be consistently followed into the next accounting period also. Why this consistency principle is followed? Because there should be a possibility of comparison. If there is no consistency, the comparisons will not be possible. That is known as the concept of consistency. So it says that the accounting concept should be same and should be applied consistently year after year. So let's see an example about depreciation. There are many methods. So in 1 year you are following one method, next year another method, there is inconsistency. So if one method or accounting procedure is followed, it should be continuously carry forward to the next few years also. Then only the comparisons will be possible. So the lack of consistency would result in non-comparison of the accounting results. So it may be a problem, or it may be a problematic to the top level managers, to the investors. They will not be able to make certain good comparisons about the accounting result. And the insistence of this concept would result in avoidance of the window dressing. If continuously there is a change in the accounting practices, that may result in window dressing. So this window dressing limitation also is overcome with the help of the concept of consistency. So what is the concept of window dressing? The books of accounts are shown at a better figure, a good figure than what the actual figure it is. That is known as the concept of window dressing. Next one is the conservative principle or conservatism. The conservatism principle says that is the playing a safe game principle. That is known as conservatism, which means you should not anticipate the profits, and we should anticipate and recognize all the losses. So in terms of profit, if it is an anticipated one, it should not be recorded. But if an immediate loss is there, it should be anticipated and it should be recorded. That is known as conservatism, playing a safe game. About all the losses, that should be considered and treated. But if it is a loss, if it's a profit, it should be considered, but it is not actually recorded. So this is because the business is done in a situation of uncertainty. The principle is there because the business is in an uncertainty situation. So this concept means that anticipate for no profits, and we should recognize all the losses, which means that are certain. And it is restated as delay in recognizing the income unless one is reasonably sure. So if you are reasonably sure, then you can have a delay in recognizing the income. If it is received, we can wait till it is received. But we should immediately recognize the expense. It should be accounted. Immediately it should be brought into the books of account when it is reasonably sure. So that is known as the conservative or conservatism principle. Next one, timeliness concept, which means all the transactions are to be recorded into the books of accounts at the proper time. Don't wait or don't postpone the transactions to a future period. And we may lose some of the transaction, we may forget some of the transactions. So these all things will happen. So this principle says that every transactions must be recorded into the books of account at the proper time as and when it is recorded or when it is happened. That is why we are recording the transactions into the books of account in a chronological order or in a date-wise order. So if we are recording it in a timely manner, we can avoid manipulations or misplacements, misappropriations, etc. So that problems can be avoided at the time of timely recording of the transactions into the books of accounts. So in this video, we were discussing about what are the basic principles and what were the modifying principles. Thank you for watching the video.